Welcome, everyone, to this episode of the Expansive CEO podcast. I am your host, Hannah Chapman, and today is Thursday, September 25th. It is currently 1:12 p.m. Pacific time, to put a time stamp on it so you know that this is another episode of Investment Friday. And we have a special episode today. So I've got Brad Haines here with me, Chief Investment Officer of Juncture Wealth Strategies, my usual bud, and we've got a new friend today. Her name is Rachel Guerrero. She is a mortgage lender here in the Phoenix area, and I'm so excited to introduce her to you. So I'll give you a little short bio, and then we're going to go into a an update because we've been off. We were off last week, so we have 2 weeks to cover with a market update, and then we're going to talk about housing prices, mortgages, all kinds of stuff today. So Rachel has been in the financial services industry for 20 years. We are almost exactly the same, so that's super fun. And she really helps individuals achieve their long-term financial goals through real estate. She creates authentic relationships with those that she serves, and she specializes in helping her clients with their home buying and refinance needs in Arizona, Montana, Hawaii, Texas, Ohio, California, North Dakota, a bunch of places. So if you're listening to this from any of those places, you know you can reach out, and all of Rachel's information will also be in the show notes. So there's all of our to get started info. Let's dive in. Brad, how you doing, man?
I'm doing great. I'm doing great after you took that 2 week vacation,
It's not 2 weeks.
just chilling out, relaxing on the beach in the Caribbean. I'm sure, at least I hope, but you
Not
know,
quite, but I did have a really nice weekend last week. Adam and I were out from Thursday through Monday.
that's
It was
fantastic.
super fun. The grandparents, his parents watched the kids for a couple of days, then my mom watched them for the other couple of days. And it was just, we had such a good time. It's so needed.
Mhm.
Like you really have to. You gotta take time with your spouse or your partner to just have like adult time, right? It's like we are next week we're out because we're taking the kids to Disneyland. So it's only fair that we have our adult connecting time, and then we take a trip with the kids.
Yeah, and you're going to need it if you're taking them to Disneyland. That's going to
Yeah.
stretch everybody.
It's gonna be good. It's gonna be so much fun.
It is.
But
It
yeah, it
is.
is very different from having like a relaxing time
Mhm.
with your spouse. So let's talk though, because it's been 2 weeks. So what has been going on? We've hit a couple of highs in the market. We had a Fed meeting last
Last
week.
week.
It was on the 17th. Yeah, it was last week on the 17th. So yeah, what's been happening so far?
Well, I would like to say not much, but actually a lot has been happening underneath the surface. So again, last week you mentioned we had the Federal Open Market Committee, which is the committee in the Federal Reserve which sets the short-term interest rates. And they reduced interest rates by 1/4%, or 25 basis points in Wall Street jargon. And they started to signal more cuts ahead between now and the end of the year. Probably two more cuts is what they were signaling, which means that's good because that's kind of what was already embedded in the equity and the bond market expectations. Um, Now, counter to that, we've had some decent economic numbers, particularly with new home sales coming in 25% above their expectation this week.
Mhm.
Now, that's new home sales. So that is homes that were constructed for the first time, and people are moving into these homes, and they crushed the expectation. Also had some other good things happening, and so now people are starting to wonder, economists are starting to wonder, do we actually get the interest rate reductions in 2026 that we were
Mm.
kind of expecting? And to all the viewers and listeners to this podcast, you will go back to the last podcast uh, episode that we did where I said the market may be ahead of itself in how many interest rate cuts we're getting. And
Well,
so far, go ahead.
oh, well, I was going to say like today, the market, well, S&P 500 at least was down 0.5%, and
Mhm.
yesterday we were down as well. And so, yeah, is that kind of coming off of kind of the rally, the
That's
euphoria maybe that we experienced, and then like, oh, wait a second, we might not see these rate cuts. Is that what we're seeing with this
Yeah, yeah,
downdraft?
definitely. There's a readjustment going on that what with third quarter GDP come out and say, hey, we actually grew actually second quarter 3.8% in GDP relative to a negative the quarter prior to that,
Right.
right? So now we're and 3.8% GDP growth is really good. Like it's really good. And so if that continues to follow through, and jobs seem to be stabilizing. And if they continue to stabilize a little bit, then do we need interest rate cuts? And that's where the market is starting to reassess. Now, we did start to pull back. We're about off about 1.5% from its all-time high. Again, that is really mundane volatility, to be honest with you. And so nothing to be too concerned about. But again, I'm still in the expectation that if growth stabilizes, if GDP growth stabilizes from here on out, then we may be looking at fewer interest rate cuts over in 2026. We might get one or two again still here in 2025, but really the market's starting to look at 2026 and price in, where is that funding cost going to come in?
Well, I think this is probably a perfect point to bring in Rachel. So, Rachel, hi. I
Hi.
would love for you to introduce yourself a little bit further.
Mhm,
Tell us a little bit more about yourself. And then, yeah, let's dive into this because we've got the new home sales numbers
mhm,
coming out. That's super interesting. And 25% is not like that is a weirdly astronomical beat. Like
mhm.
it's not like 3% or 7%. Where you're like, man, that was good.
Yeah.
25% is a lot. And then we also have a really, I think, important question that I wanted to pose to you about what are points
Mhm,
and what does that mean? And what are we talking about when people say, points on a mortgage or you're buying down points or I had to pay this much for points?
mhm.
What does that mean? And then I'm going to share like a really interesting client scenario that came up this week. So, hi,
Yeah.
Rachel. Thank you for being here.
Hi. Hi. No, thank you so much, you two, for having me. I am just excited. We're in the real estate market has been changing drastically the last, 5.5 years. I've been in banking for 20 years and originating home loans for 8.5. So it's just kind of this big, fun financial puzzle that's kind of coming together. And so I'm from Arizona, born and raised, and people often they ask me, why are you licensed in so many states? Well, I have a lot of friends and I know a lot of people, and it's nice being able to make connections in this, you know, throughout the US and being able to serve my clients. And so we have seen, as Brad was talking about, the Fed rate cut last week, 0.25%. That was the first time that rates have been cut this year. And so much hype goes behind that cut. And I think that it's important to note that when the Fed rate cuts happen, that doesn't directly impact mortgages. Like people automatically think that mortgage rates are down 0.25%. And it's not the case because the Fed rates and the short term rates that affects your credit cards and your auto loans, home equity lines of credit. So we see a lot of buildup and excitement in mortgage rates prior to the Fed actually taking these actions to try and improve the economy. So we've been on this really good run throughout much of September where mortgage rates have come down pretty substantially. We're below 6.5%. And these are numbers that we haven't seen realistically since like last September is kind of when we hit our last lows. Um, New home sales are up, application volume is up overall with I think home buyers and homeowners are just they're tired of sitting on the fence waiting for things to happen in this market. They keep waiting for rates to drop. And we're not necessarily seeing it. We're not seeing the 4 and 5% that we really want to see, but you
Yeah.
can only wait so long before you have to make these moves.
Yeah, and since you are licensed in so many different
Mhm.
states, I think that also that's an interesting or you have a maybe a more broad insight versus,
Mhm.
especially if we talk to realtors that are really steeped in one area, they'll know what it's like when I was in Cincinnati. What is it like in Cincinnati? Or, what is it like in San Francisco? What is it like in Phoenix? But these are all their own places and their own
Mhm.
microcosms. So yeah, I'm curious if you see bigger trends over, these different states that you
Mhm.
serve. Are there some bigger trends like countrywide rather than
Mhm.
just looking at the Phoenix market in particular?
Yeah. So I think we all kind of came to a standstill this summer.
Mm.
Everything started to really slow down in multiple regions. I mean, in Phoenix, where our inventory is sitting at, over 22,000, I believe, is the current number of homes available kind of throughout Maricopa County. Up in Montana, homes were just kind of sitting. And I think that's that standstill. You're also faced with it's summertime, summer break. People are out on vacation. They're not exactly thinking about buying their new home. But as we've crept closer to the Fed making that rate cut announcement and mortgage rates following suit and seeing this rally that we've experienced in September, people are finally they're making the moves. They're submitting the application because they're taking advantage of refinance opportunity or they want to buy that house that's been sitting on the market for 60, 90 days. There's a lot of incentive there to be able to finally make those moves.
Well, Brad, can you speak to the new home number a little bit? And let's go there for a minute.
Mhm.
Yeah, I mean, new homes, it's interesting because my daughter and son-in-law just bought their first home.
Oh, congrats.
Yeah,
That's
Big deal.
exciting.
that's amazing, right? I thought it was fantastic for them. And they did it without dad's help. So that is even better. I just want to
Congratulations.
congratulate them because they did an amazing job. However, what is interesting is where they bought, the type of property they bought. And I'm wondering if this is true in Phoenix and in some of the areas you're looking at, which is they bought a townhome.
Mhm.
So it's kind of a side by side, almost like a brownstone, but obviously just built brownstone. And this particular builder was closing out this development. So they built probably 200 browns, like 200 side by side townhomes. Sold all of them. In fact, my daughter and son-in-law were one of the last ones to purchase the units. And it's interesting because almost all of those units are people in their demographic,
Mm.
young, just graduated from college, or are a couple years out from graduating from college. They're starting their jobs, or they're, construction guys that have kind of worked up to a pretty decent position, and so they were able to purchase these homes. And so it's interesting if that's the dynamic you're seeing, Rachel, across your
Mhm.
footprint that you're aware of.
Mhm.
If younger couples are opting for those new homes rather than single family residences on the existing market.
Yeah. So I think that what we're seeing a lot of these builders being able to offer is incentives to lower the interest rates to be able to improve affordability to move families into their homes. And it's something that on the resale side, so the homes that have been established, you've got true sellers on those. They can't necessarily compete with the builders that are advertising 3.99, 4.99% interest rates.
Right.
And so oftentimes what we're seeing when those builders are showcasing those interest rates, there's a cost for them to be able to offer that. Sometimes it's a markup in the cost of the home itself to then be able to buy down the rate on the home. Um, but they need to do it. They have to move their inventory. There's a cost that these builders are carrying if their inventory is just sitting stagnant and they can't turn those homes. Um, I know that I mean, affordability in general has been a big topic of conversation since rates started to increase 3.5 years ago. As rates have increased, you have less buyers that can, that can qualify to buy. what actions need to happen to be able to continue to help. And, are we going to start seeing an infusion of money back into mortgage-backed securities to make borrowing money for a mortgage more affordable for the consumer? I was having coffee the other day with an insurance agent. She's fresh out of college, just graduated last May, and she doesn't know how she's going to be able to buy her first home, and that's a big challenge. It's the American dream, right? Is to own your own home. It used to be the average age of a first time home buyer was actually 33. And I think the most recent stat that I saw just a few months ago is it's jumped to about 38, if I'm not mistaken. Brad, maybe you've seen the numbers. But that
Yeah, it's
age,
somewhere around there.
it's increasing because now the older you get, typically the more established your income is, and you've got the credit and the assets to be able to support these down payments.
Yeah, it's crazy. I saw an economic research article that said in 1960, what percent of young adults were married and owned a home
Mm-hmm.
that had turned 30. So 30-year-olds who owned a home and were married. So in 1960, what was that number, you guys? What's your guess?
I would guess like 65%.
Okay, fair.
Oh my gosh. Yeah, I have no idea. 65%, Hannah, for the win.
Okay,
All
so
right.
you guys are standing strong on 65. It was about 58%. So
Okay.
not
Wow.
too far
Not
off
too
that.
bad.
But
Okay.
if it was Price is Right, I still lose.
Yeah.
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 It went
Guess
over.
what?
$1 bomb.
Yeah, you went over. You're done. Uh, guess what it is today?
Oh gosh, I'm gonna say 30,
Yeah.
32.
Yeah.
19.
Wow.
And part of it's a dual probability event, right? It's being married and owning a home.
Mhm.
Mm,
So part of it is we're just getting married later.
Mhm.
A lot of couples are waiting. They're living together, but they're not getting married. They may purchase a home together, but they're not married, or they are just waiting to get married and then move in and buy a house. But it's an interesting kind of telling thing. Does that mean that beginner homes are no longer going to be the product that they have been in the past decades, where people would buy an entry level home and then they'd move up once or twice, and then at the final home, their quote unquote home that they raise their kids in, um, prior to going into retirement. It'll be interesting to see if that trend continues, or if they just skip the entry level home and go towards the kind of secondary move up home.
I think that's a lot of what we're seeing. And, cost of goods and the cost to build these projects have just skyrocketed, the last 5 years. And so it's a lot more expensive for these builders to put out a product. These starter entry level homes. We're seeing a lot of the kind of the brownstone style or those super small single family homes being established out here because builders are trying to create a product that they can turn for those first time home buyers. Um, but yeah, I don't know. I don't know. I think that it's also hard. We're in a generation where they like nice things, right? They see what's on TV, and you buy this starter home. Maybe it has the lower end finishes. It's not the granite countertops, and they turn away from that. They want the granite and the vinyl LVP flooring or tile flooring. They want a nice home, of course, and it makes sense. But it's just finding what is that true starting point need to be.
Look, my first property that I purchased, that my wife and I purchased, it had linoleum floor, it had cheap carpet, and we were ecstatic to
Mhm.
get it. I mean,
I
we
I
were.
I bought my first home 2010. So it's, coming off of the housing crash, foreclosures and everything. I almost canceled the purchase contract on my home because I thought it was just ugly. My husband was like, Rachel, the Formica countertops, they'll be the first to go. I think we cooked on those counters for like 5 years, 5.5 years, because you can cook just the same on Formica as you can granite.
Hmm.
Eventually, a couple of years after owning the home, we ripped out the dirty, shaggy carpet and, but it takes time. A
Yeah.
lot of it's sweat equity and building equity in the home. And I think that's really, if we could get people in, you will see the return, even if home appreciation is slowed down to roughly 4% is what we're averaging right now. So you're sitting on 4% return just by owning a home. And a big thing to realize is our mortgage payments are higher because interest rates are higher, but there is a portion of that payment that's going towards principal every month. So you're secretly putting money aside because that principal payment's lowering that balance. And in turn, you're also building equity on top of that.
Yeah.
That's a really interesting dynamic too. That as I've shared on the podcast many times, my family moved about 3 months ago now, a little over 3 months ago. We got into our new house in Phoenix area. Um, but as we were looking, we were paying attention for quite a while. We knew we were going to move maybe a year ahead of time, and we're looking, just paying attention to the market, kind of seeing where things were, and seeing a lot of people listing for double or nearly double when they had, like you can see in Zillow when the last time the home was sold, like it sold in 2021 or sold in 2022, and they think it's doubled in price in the last 2 years. And then what's been happening, Rachel, I think you mentioned this before, like then they sat.
Mm-hmm.
Right? Those homes that has not been working, especially this past year. We saw homes in the price range we were looking at homes sitting for 3 months, 6 months, 9 months, 12 months. This house was on the market for a full year when we put in our offer.
Mm-hmm.
And I mean, it was just like it was interesting how the market or maybe the sellers hadn't quite digested what was happening and lowered expectations accordingly. Are you still seeing that?
We are still seeing home sit. And that's where working with an agent that's knowledgeable of the area, whether you're the buyer and can go in with an appropriate offer or you're listing your home, your agent is going to have the statistics. They are going to be able to tell you average days on market. You could still get an offer on your home the first week and you list it. But it's what's that motivation to sell? Are you trying to make top dollar or are you trying to sell your home quick? Now you don't want to undercut yourself. Your neighbors are going to hate you if you list super low. But yeah, it's setting those realistic expectations. But we're still average days on market is pretty close to 2 months here in markets throughout the country. And so that's been a shift in mindset for these sellers because 5 years ago when rates were 3%, you had an offer before the for sale sign was in the yard.
Yeah.
Mhm.
Well, okay, so I want to talk about let's talk about points for a little
Mhm.
bit. What are points? How do you describe them to
Yeah.
people? So yeah, and what does it matter? You mentioned it a little bit in the new home
Mhm.
discussion as well, but yeah, let's dive into that a little bit more.
Yeah. So points is a very confusing term that people hear, but they don't understand. And realistically, points are a certain percentage amount of your loan that you're paying up front in closing costs to get a lower interest rate over the long term. And so there's rate sheets that come out every day with every mortgage lender that you work with. And we look at the interest rate and what is the interest rate that we can offer to you at no charge at all. And if we want a lower interest rate, how much is it going to cost us to get that interest rate? Points are going to change every single day, and sometimes they change during the day depending on what's going on in the markets. Sometimes we see reprices for the better, and that same rate may not cost you as much today as it did when we started the day. So it's interesting right now because, in general, we do believe that mortgage rates are going to come down. It's just a matter of time. We've been in the 6 to 7% range for quite some time now. When you pay points to get that interest rate lowered, a lot of these investors are charging more for points right now because they know it's very likely that you're going to refinance sometime in the future. That loan isn't going to be on the book for, 20 or 30 years for them. So what we're seeing right now is interest rates are being advertised, but how much is that interest rate actually going to cost the consumer to be able to obtain? And does it make sense to the consumer to pay points? And at what point does it make sense to, I'm just going to take the interest rate as it is. I don't want to charge or pay anything extra for it. Um, I have a client right now. She's under contract up in Montana, and we're looking at should she pay points or not. Um, if she does pay points, how much is it going to save her on a monthly basis? Her goal, she has two goals. It's kind of this double-edged sword. She wants the lowest monthly payment. We all do. She also wants the most amount of money remaining in her pocket when all is said and done.
Mm-hmm.
And so we compared, what is her rate going to be if she doesn't pay anything or the least amount of cost possible. She's looking at having to pay private mortgage insurance, which is another fee. So realistically, in her instance, she's going to pay a very small amount of points. She's lowering her interest rate by 0.25%. So it's saving her about $55 a month on monthly payment. And she's opting to pay the private mortgage insurance.
Mm.
So because she knows that she will probably refinance sometime the next 12 to 18 months. And at that time, we'll take a look at what are rates and maybe we can get rid of that PMI for her.
Ooh, yeah, because then the house will have hopefully appreciated as well, right? So you
Yeah.
get the spread on both
Yeah.
sides.
Yeah.
Well, and then
But
she saves not just an interest cost, but she also saves with that PMI monthly premium coming out. So that'd be great.
mhm. But what I am seeing, I work for authenticity and transparency with my clients. It's so easy. I do this for a living. I crunch numbers every single day. The average Joe on the street doesn't know what we do. And it's so easy for individuals, unfortunately, to be taken advantage of
Mm-hmm.
by they don't understand the true cost of the loan and they don't understand that they have options. They have these lenders that'll say, I could get you a 4.99% interest rate. Yeah, that sounds really great. But then on the tail end, they're seeing that they paid, you know, thousands and thousands of dollars to be able to make those numbers happen.
Well, I'd love to give an example here, because this is a relevant situation happening. I had got a client question this week that was exactly in this realm that, rates, how do I want to say this, out in the world, they're like, oh, rates are coming up, interest rates came down, right? So yeah, more people are waiting, like you're saying, waiting for the mortgage rates to come down. And so this particular client, his lender sent him, this communication that, hey, we could maybe lower your rate. Would you like to look at that? So, sure, let's look at it. So it sends me the information to look at, to be like, is this a good idea? Should we do this? Well, what it's showing is he could lower his payment by $600 a month, which is quite a bit. He could lower his interest rate by, it's currently at 6.375%, which is on the lower end of what we've been seeing recently, right? And this mortgage lender said, okay, we can get you in at 5.99%. And so it's going to lower your monthly payment by $601. And on the surface, you're like, oh, okay, great. That seems like something. What is that going to be? So, all right, well, let's dig into it. Let's look at what this actually costs to get. And what was actually happening inside of that was the mortgage lender was essentially buying down 1.5%. So 1.5% fully to get to that 5.99, which means the true rate was 7.49, right?
Mm-hmm.
So the true rate was much higher, but they were paying almost $9,500 in points to get it down to that 5.99%.
Mm-hmm.
And so then when we look at the math, it's not, just, okay, the refi itself costs, 2 to 3 grand. That's pretty normal, right? Loan
Mhm.
origination costs, like you should get paid for the work that you do, right? All of that, that makes sense. We're not just looking at that break even cost. We're looking at, okay, now we have to see what the break even is on $9,500 additional.
Mhm.
So that means like, okay, if you have that savings for that amount of time, it's still going to take, I think the math was almost 3 years
Mhm.
to break even.
Mhm.
And that's, we wouldn't look at that norm or like just a regular person who doesn't look at these numbers all the time isn't going to necessarily realize
Mhm.
that no, this
Yeah,
is actually costing you quite a bit if you go with this option.
absolutely. And I think to go beyond that, it's okay, our break even's 3 years. What does your plan look like? How long do you anticipate being in this home? Do we think that interest rates are going to move lower? And the answer is yes, they will move lower. At some juncture, they'll come down. But does it make sense to pay nearly $10,000 now to save $600 a month in payment? And for some, that $600 is, it's a game changer for their family to help put them in a better financial position. Bills are tight. Everything is more expensive right now. But what's the long-term ramifications? Where is that $10,000 extra coming from? Is it being rolled into the loan? Are they pulling it from savings to, pay those closing costs on top of everything else? So it's really just being able to work with an individual that can help them visualize that so that they're making the best decision. And in that instance, not knowing his, his true familial situation, it probably doesn't make sense to lower the rate by 0.3%.
Right. Yeah, exactly. And that was my instinct as well, is that okay, if they're what it seemed like to me is that the mortgage company was kind of trying to front run the information is what it
Mm-hmm.
feels like, right? Like, oh, here's an opportunity for you, but we're gonna make a little extra money here because we're selling
Mm-hmm.
this with points.
Mm-hmm.
Right, rather than just like, oh yeah, rates are actually down at 6% or 5.99, so you can get in there.
Mm-hmm.
So where then can people find this information? How do people like if someone else is getting this same push, this marketing push, 'cause that's what it
Mm-hmm.
is, and like
Yeah.
no shade for companies trying to market, right? Like that's fine.
Mm-hmm.
But how do people find out this information for themselves? What are the questions they should be asking?
I think they need to first find out what's the true cost going to be. How much is this refinance going to cost me? If I were to write you a check to pay all those closing costs, what's that going to cost? Second, how much am I going to save every month? I think figuring out the break even is important. So, how long is it going to take me to recoup those costs? Is it 6 months? Is it 36 months? That's a big difference. And then just look at the numbers and how much do they need to benefit on a monthly basis, I think is most important to be able to make that decision to move forward.
Hmm.
I also, to piggyback, I think that what a lot of consumers don't realize, and every investor is going to be a little bit different. You don't always need to refinance back out into a new 30-year loan. If you've been paying on your loan for 2, 3, 4 years, you may have the option to do a 26, 27, 28-year loan so that you're not re-extending it and paying that extra interest over the life of the loan. Your monthly savings won't be as much because a 28-year loan versus a 30-year loan, so but breaking down that interest savings may make a lot of sense just to keep the loan term remain, keep that loan term in place. And maybe even we could look at, with interest rates coming down, rather than doing a 28-year loan, what does a 20-year payment look like? What is a 25-year month? What does that look like? Is there enough savings there? Where it would make sense to proceed with that option?
That's really good.
Well, and I think I didn't see this I haven't seen this so much in this cycle, but in the last cycle, I saw a lot of people. refinancing just because the rates were lower and
Mhm.
they could save money. Um, but they were refinancing 30-year mortgages, but in their own mind, they said, yeah, within 5 years, I'm going to sell this property. So
Mhm.
they don't consider their holding time, their holding period for this house that they live in. They don't consider that as much as maybe they should,
Mhm.
because if you're going to be selling your house in the next 3 years, you may not be breaking even. In fact, you may just be costing yourself more money if you want to move up in the next couple of years or move to a different, geographic location and such. So I haven't
Mhm.
seen that now so much, probably because the interest rates, the mortgage rates haven't moved as much. But I thought that was an interesting dynamic last time.
Mhm. Yeah, at homes were sitting, people were retaining homes for a couple of years, 2, 3 years, and then they were flipping them and moving on to the next venture. But yeah, we're seeing that a lot more. I think a lot of people there nowadays, what we're seeing is that because costs of living is so high, and to be able to obtain a new home, it's that payment is so much more than what they're potentially paying now. um, they're waiting, and refinancing. What I've got, from the month of September when these rates came down, I've got one family that I'm saving nearly $1,000 a month on their payment, but
Huh.
their interest rate was near 8%. And we were able to drop their interest rate by a full 1%. And without looking at numbers, I don't think we're charging points actually. That was par, for them. But I mean, there it makes sense. Even if they move in the next 2 years because their lifestyle changes or whatever, saving that $1,000 a month is a lot more impactful for them. I'm
That's
also
big.
having a lot of conversations right now. A lot of lenders will roll closing costs into the loan. Makes
Mhm.
sense for the consumer in many instances because they're not having to write that check when finances are tight. But in lieu of that, consider, maybe you're skipping 2 mortgage payments by doing this refinance. What if you take your current mortgage payment that you were going to make for the month of October? What if you took that amount and you applied that towards closing costs? And you're not having to roll that into your loans, you're financing less. So you're already going to spend that money anyways. Just use it towards your new loan and save yourself on the long run.
These are amazing tips. I appreciate it. Rachel,
There's been a lot of loan officers that have not survived the last few years. And, it's taken a lot of time to kind of work with the markets and understand what consumers are really needing to look out for their best interests. You're not in it just for the paycheck. You're in it because you're truly making a difference in somebody's life. I mean, your home is your largest, asset that you can own, physical asset.
absolutely. I so appreciate you coming on today, Rachel. This was super fun. I don't think we've ever had a third guest on this.
This is our first
What?
guest ever.
Yeah,
I'm
So,
honored.
Rachel, you are the number one in our
Thank you.
book.
Thank you.
Yes, thank you for coming. And all of your contact information will be in the show notes in case people have questions and want to learn more. And you're in one of those market areas where that could actually help and be able to benefit your own situation. Because, yeah, rates are coming down. But also, per our cautionary tale here, like make sure that you're looking under the hood, pulling back the curtain, like understanding what is actually going on in that potential loan offer that you're getting.
Mhm.
It's really important to understand all those factors. And Rachel, to your point, the the monthly savings might be really important,
Mhm.
or the long term, the interest that you pay over time, the holding period that you have, those things might be more of a consideration. So
Mhm.
having someone that knows your situation that can help you um, really look at all the factors rather than just the bottom line really, really is important and impactful. So thank you.
Absolutely.
Thank you for
Thank
being an
you.
advocate for your clients. It's so
Thank
wonderful.
you.
Brad, any last thoughts for today?
No, I think it's really important because I think people, I think one, buying a home is such a complex transaction. And as Rachel mentioned, it is one of the largest transactions people will ever do. And you're only going to do it once, twice, three, maybe four times in your life. So please get good advisors like Rachel, good real estate agents to help you walk through that process, because there's a lot of pitfalls they can make. They can do a lot of value add for your transaction. So that's I just want to leave our viewers and our listeners with that type of comment.
Perfect. Well, thank you, everyone. We will see you next week. And as always, if you have any questions, thoughts, concerns, anything coming up that you would love for us to kick around, answer on the podcast, we would love to do that. And actually, there might not be an Investment Friday next Friday, because
Oh, yes, there will.
if you are you going to do it then?
I may do it by myself. I may do it
Okay.
by myself.
Okay. We're putting it, it's going out. So this, people are hearing this. So they're going to expect your beautiful face next week all by yourself.
Okay,
You
I will
got
try my best.
it? Thank you, everyone. Have an awesome week. That's it for this episode. Thanks for listening, and be sure to like and subscribe. And again, if anything resonated with you from this episode, I would love to hear from you. Email me at Hannah, HANNAH, at expansiveceo.com, and tell me about it. And if you're ready for your greatest expansion, you can find ways to work with me at expansiveceo.com and at x2wealthplanning.com. That's X, the numeral 2, wealthplanning.com. So until next time, remember that there is enough. You are enough. And your birthright in this lifetime is to be expansive.